Hello, everyone, and welcome back to the all-new Blueprint Strategy course. Today is going to be a very interesting lesson because today we'll focus on the charts and practical applications. We've covered a lot of groundwork in terms of just theory, and we've done some practical applications based on the theory that we covered so far. However, we haven't really gone into depth in terms of practical applications. And why we haven't gone into depth in terms of practical applications is because when we go into practical applications, we need those conversations to be extremely complex. And so now you have a strong foundation in terms of your technical understanding. You understand the two first steps of the supply and demand process. You understand location, you understand direction, and you also understand our primary setup tool, our primary fundamental setup tool for our finite markets. Okay, so now when we cover finite markets, we can have a very comprehensive and in-depth conversation around these specific markets that we like to trade. So today we're going to start with that. And as we start with that, we're also going to start forming the blueprint of our strategy. Okay, we're going to write down the blueprint that we're going to follow. Now, what's also going to be extremely interesting is that as we go along, you'll notice that some of our setups that we talked about may have worked, and some of our setups that we've talked about may have not worked, right? So far, we talked a little bit about Palladium, and in fact, that's what we talked about last week. We talked about Palladium and the commercials and how the commercials affect the price of Palladium. In a prior lesson, we also talked about Netflix, for example. And as we talked about Netflix, we only talked about the technical analysis in terms of location and direction, and we combined the two without even covering fundamentals. As we talked about Palladium, we only talked about, or we mostly talked about fundamentals, and we spent very little time talking about technicals. Okay. Now, today I want to cover wheat. And today I also want to cover this from a technical standpoint as well as a fundamental standpoint. And I just love the chart of wheat because it is very typical for commercials trading. And if you think about that for a second, that makes a lot of sense because wheat is traded all over the world. It's the bread and food of life. And it's been around for hundreds of years. And therefore, when we look at how the commercials interplay with price behavior, it's going to be extremely fascinating how many lessons it can teach us in terms of how price moves and how the commercials interplay with that. So what we're going to start today is we're going to start piecing together all of the puzzle pieces that we've talked about already. And we're also going to potentially tease one or the other tool that I'll show you in the future, right? And what we're going to do today for wheat is something that you'll have to do for each and every market that you trade. Okay. What I'm doing for wheat with you today is something that you will have to do on your own for each and every market that you want to trade. Now, I can cover hundreds of markets in detail with you in terms of the blueprint that you have to follow. However, what I can give you, I can categorize our markets into finite, infinite, and man-made commodities. And I can give you a general blueprint on what the kind of rules are that you should be watching out for and that you should follow generally, and how that may be applicable to one asset, but it's not so applicable to another asset. And then as you follow that general blueprint for our market or asset categories, then I want to show you how you then can go into a lot of detail on each and every market, and how you then can create a market-specific blueprint for the markets you love to trade. Okay, so you will follow always the same sets of rules here. When we're done today, I'm going to share this document with you so you don't have to copy the notes here. Of course, you can always write notes as well, but I'm going to share this document with you after today's lesson within the notes section of the classroom. So without much further ado, let's go straight into our wheat markets. And let me just enhance that a little bit. And I want to make sure that we're loading enough data here. So I'm looking back 30 years now. And when we do an analysis, a back test, then we always want to work our way from left to right. Okay, what we don't want to do is start right here and then work our ways to the left, right? Because then it becomes a self-fulfilling prophecy. We kind of are cheating and we're telling our eyes already what we know, and therefore confirmation bias plays a big role here. So what we want to do is we want to go from left to right. Okay, and so what we also want to do is I want to now load in the commercials, and I'm going to load in the index. And our index, as you know, is set to 26 and 156. And I'm only looking at the commercials at the moment. What I'm also going to load in is the net positions of the commercials. And what I'm also going to do is I'm going to load in the zigzag to see the trend condition, because we don't just want to go look at the commercials only. We also want to see what's the interplay of what the commercials are doing as well as trend, as this will play a role how we look at the commercials. So let's start from potentially here and from 2005. And we're just going to work our way to the right. And then what we're going to do is we're going to write down our findings as well. So from right to left, if I'm going to start with analyzing price only, then what I'm seeing here is going to be a high, a low, a higher high, a higher low, and a higher high. All right, so 2 higher lows followed by 2 higher highs means that we're in an uptrend. Okay, so we now have a uptrending market condition. Now, the question is, what do we want to do if now the commercials turn bearish, right? If now the commercials, in other words, start distributing. Well, if the commercials start distributing, what do we want to do with an uptrend? We don't want to do anything, right? We don't want to do anything. There's no action here. And so what we can write down is that if we're within an uptrend and the commercials are below the red line, which is a 26-week extreme, then there's no action. So commercials below 26 weeks. And so that would be the red line, right? They're below the red line. Then the action is there's no action, right? So remember, there are two rules in terms of our setup tool is COT. There is either the trend following rule and there is the end of the band rule. And so the end of the band rule would be applicable here. And then we would only act if there was a 3-year extreme. Okay, but just follow me for now. So there's no action, so there's nothing else that we would have to track here, right? Because generally, if we have this combination, then there's just no trade that we can take. Now, if we continue and we follow our commercials, then eventually the commercials are, for the first time since we saw this uptrend condition, for the very first time, they are now here starting to be at the 26-week extreme in terms of accumulation. And they are, in other words, bullish here, right? So in this case, since we're still uptrending, right, and it will depend how you argue this. If you argue this as a downtrend, right, or you argue this as an overall uptrend, I think if we do it like this, this is going to serve us a better purpose, right? And then we have a higher low here, and then we know we have higher lows and we have higher lows and so on, right? So this has to be an uptrend. This cannot be a downtrend. We could call this a downtrend. However, that downtrend would be within the higher time frame correction move, right? So there you then are talking about different trends, and then the bell curve and lower time frame trends and higher time frame trends. Here we have a correction move, and within that correction move, if I'm going to draw smaller zigzags, within that correction move, I may have a downtrend on the lower time frame trend. However, that doesn't mean that within the higher time frame trend that this is a downtrend, right? This is just a correction move. So, well, as we do this automated, we could also change around the pivot points here, and that may then give us a slightly different viewpoint. However, whenever we disagree on something, we could just overwrite this as simply as that, right? And we could just overwrite this. So the zigzag tool, right, is just supposed to make our life a little bit easier. It's not supposed to take all decision making away from us. So here we said, let's overwrite this. We're at a higher low here. And if this is a higher, well, if we're still within an uptrend here, if we're still arguing an uptrend before this higher low is being formed and the commercials are accumulating, so if we are now uptrending and the commercials are above a 26 weeks high, so they are above the green line, then there is an action required. And what's the action? We're going to be buying, right? Where are we going to be buying in terms of location? Well, we're going to buy in weekly and or daily demand. When, that is something that will come into play later. Then we could also ask when. If we ask the question when, then we're asking a seasonal question. Here we would say, well, during a seasonal low, ideally we should be buying here. So now, what is our profitability and what is the accuracy here? We cannot put numbers behind that just yet. However, what we can assume already is that my profitability is going to be high and my accuracy is also going to be high. Okay, so that's just something that we're going to assume for now. However, as we do an entire back test of at least 10 of the same parameters, then we would still have a small sample size, but based on that small sample size, we could then say, for example, well, 8 out of 10 times in the past this worked, and then, well, what is my accuracy? In other words, what's my probability of success? Well, it's 8 out of 10. In that case, I have an 80% chance, if I have an uptrend and the commercials are at a 6-month extreme, that if I buy within weekly or daily demand, that I have an 80% likelihood that this trade is going to be positive. Positive by how much? Well, it depends on then the seasonality and your market timing aspect, how small is your zone, and so on and so forth. But this pillar right here and these pillars we can't yet answer, because here we just don't have the data yet to second our claim. And here I haven't shown you our seasonality tool yet, so you don't know yet. But when we ask the question when, that's when we would generally speak about seasonality. So now I know, well, uptrending, 26-week high, I want to buy, right? That's the trend following rule, and I want to buy within weekly and daily demand, and usually I should have a high accuracy and a high profitability. So if I now continue going, right, and I continue to the right, now the commercials are below the red line. What do I want to do? Well, I'm in an uptrend. I don't care whether the commercials are below the red line. I only care if the commercials are touching the yellow line, the 3-year extreme. But let's just continue to follow our here again. We're starting to be above the green line, right? We're starting to be above the green line on the commercials. And so what do we want to do again? Well, I'm uptrending. I'm above a 26-week high. I want to buy. Where do I want to buy? I want to buy in weekly and daily demand with the trend. And then here as well, eventually as we buy low, we may have been able to, well, we may have been able to predict that, and we may have been able to predict that as well, right? And could we have predicted the magnitude of those moves? No, certainly not, right? We don't know if beforehand, we don't know if that's going to be a 5-week rally, if that's going to be a 5 months rally, if we could have never said that, well, price is going to double. We could have never said that, right? But what we could have said at that point, and definitely here as well, well, we could have said the trend is up, the commercials are relatively, well, the commercials are accumulating at a relative extreme, and therefore I want to look to buy as well. And as I position myself to the upside, at least I get a chance to have a piece of the cake here, right? I'm not saying that we should take that entire move to the upside. That's very unrealistic. I'm saying we can position ourselves into the right direction here. It goes with the trend and with the commercials to get potentially a piece of the cake here. That's all we're looking for, right? A piece of the cake. So now we have 2 instances, right, with the uptrend. And if I'm looking further to the left, then I could potentially even count this one already, right? If this is our low, then I've got a higher low, then I've got a higher low. Then if I count this one already, because only here I then have an uptrend. Here I don't have an uptrend yet. Here I don't have an uptrend. Here I don't have an uptrend. Only at this stage I have an uptrend because I have 2 consecutive higher lows. So here I have an uptrend. So here as well, I could have predicted that to be a rally. I could have predicted a rally to come here. I could have predicted a rally to come here eventually as well. And so already if I now had to put an accuracy here on our trend following trades, then it would be 3 out of 3, right? It would be 3 out of 3. So we're not going to have 100% accuracy on this over the long run, but already we're seeing, as we follow the trend with the commercials, that we usually get pretty solid setups. And then what's going to happen is eventually, well, first the commercials go bearish again here right below the red line. But what do? We do nothing. And so if you now test the against the trend versus bearish, then you see a clear difference between the accuracy, your probability of success, right? So now you can see, well, here it told us to sell. And yes, we could have sold for a little bit, but it's not very profitable. Price took a very long time to just move a tiny bit, but it did work, right? It did work, kind of. And then here it didn't work at all. And then here it didn't work at all. So basically we have 1 out of 3, which is only a 33% accuracy and a low profitability. While if we follow the trend and the commercials, then we have 100% accuracy and a very high profitability as well as we're trading the impulse move. So you already see, as we're backtesting just 3 years here, well, just 3 years, almost 5 years, right? From 2005 to 2008, well, 4 years. Then you can see, well, what would we rather do? Well, we would rather trade these 6 months extremes, these 26-week extremes. We would rather trade them with the trend. So this is how we come up with the rules, right? We did an extensive back test on all the markets that we traded. And then we said, well, what is the best logic behind those tools? And based on the best logic, what should be the rules around that? So you can see now already it's quite self-explanatory. Well, we only want to follow the trend here until, and now this is where it becomes interesting. Now we're still uptrending, right? But in March, on the 21st of March, 2008, for the very first time in a lot of years, our commercials touch the yellow line, which means at this point, it's a 3-year extreme. So this then, what comes into play now is our end of the band rule, right? So now we have three years. Well, let's stick to weeks. So 156 weeks. So 156 weeks, which is the lower yellow line, okay, and below or at, right, equal, equal, because we can't really go below that line. It's an index. So if we basically, I need to do this and this, right? Yeah. And so if I go and I touch the lower yellow line, it means that I'm at 156 weeks extreme in terms of their distribution. And so what is the action here? Well, that's the end of the band rule. So regardless of trend, I'm going to be selling, right? Where am I going to be selling? Well, I better sell in monthly and or weekly supply, but I'm not going to sell in daily supply. And a caveat here is as well, and that's where, again, we could add on to this skeleton of the blueprint, let's call it, right? This is only a skeleton of the blueprint. This can become very complex depending on the tools that you're adding here in terms of price action. So Tobias at the moment is making a course. If you haven't seen that yet, maybe I can tease that. And Tobias is making a course here on price action. Oh, that's the old one. Here, OTC price action, including campus indicators. And he's going into each and every price action tool, and he's going to explain how this can be used. So we could have, in terms of market timing, another column here, and that's also what we're going to do eventually, is add another column once we speak about the lower time frame as well, and the market timing, that we can say, well, what are some other tools to potentially enter the market here? because as it comes to location, what is an example here, for example, on this case, is that it's an all-time high. Price has never been there before. So of course, there's not going to be monthly or weekly or daily supply. As we look to the left, there's nothing. So we need other tools to potentially look to short here. And the tools that we're going to use are these price action set of rules. So maybe shooting star candles or price action patterns and head and shoulders and all these things that we can then use if there's a lack of supply as well. But here, for example, this is a very interesting one because it shifts the narrative. Okay, it shifts the narrative. So rather than being bullish, now we're gonna be doing what? We're gonna look to sell, right? And we're gonna be bearish. And so we see a drop of price. And now what's the profitability and the accuracy here? Well, we can't really say that yet, but if I'm going to be selling here against the trend, then my profitability is going to be very high. And my accuracy is going to be medium. While my accuracy is going to be medium, it's not going to be as high as trading with the trend because I'm predicting the end of the band. And predicting the end of the band just has to be notoriously difficult. So, of course, the accuracy in terms of how many times you're right versus how many times you're wrong when we're predicting the end of the band is going to be a lot less than when we're trying to follow the trend. That makes sense, right? However, when we manage to do that, our profitability can be immense and a lot higher as we're potentially going into a new trend that has not yet even been formed. So we can ride all of the wave in terms of future trends that are being formed. So what we're doing here is anticipating the end of the band. And what we're doing here is we're following the existing trend. Here, we're just not doing anything, right? No trade. Now, what's going to be interesting next is that now the commercials are again bullish, and they're bullish right here. And that means that technically we're still within an uptrend, technically speaking, right? So I still have my higher lows. And as long as none of those higher lows are broken, right? As long as none of them are broken, I'm technically still in an uptrend. So could I trade this? I could, right? I could. However, my profitability here is going to be less than trading without a prior extreme of the commercials. So let's put this into writing because that's maybe a little bit more. And you can see there's so many different conditions that could take place here, right? So now we're still uptrending. So the trend is still up, right? None of those lows have been broken. And as none of those lows have been broken, we're still in an uptrending market condition. So we're still uptrending. And now I'm again above a 26 weeks high. And that's again the green line. However, this is coming prior, post right? So this is coming post post a 26 weeks extreme. All right. So here we can still look to buy, right? We can still look to buy, and we can still look to buy within weekly and daily demand, and ideally still within a, a seasonal low and so on and so forth. However, my profitability here is rather low, and my accuracy is only going to be medium. So we kind of have to put some numbers behind these as well, but just generally speaking already, if I had an extreme before that tells me to expect the end of the band, then buying, even if I buy low in weekly and daily demand, I may buy into a changing trend trajectory. Okay, so I may buy against the impulse. And that's actually what's going to end up happening, right? We're buying, but we're buying against the impulse. So we're buying we're basically buying that turns out to be a correction. And then after that correction, we get another impulse move to the downside. So now there's something that is happening that is very tricky. And we also have to write this down into we have to put some wording around that as well. So following an extreme, what usually happens is that usually the commercials will accumulate very quickly. So they'll flip-flop very quickly, and then they'll continue to accumulate for a very long time. And this makes sense, right? Because, well, what this basically is they're not changing their minds. They're not saying, well, we anticipate a change of trend, and then all of a sudden they say, oh no, let's follow the trend. What they're saying is, well, they anticipate a change of trend, and then that's just their hedging function that comes into play. And as price declines, they're going to continue to accumulate into declining prices only until they're back at an extreme, is where, again, a level of accumulation matters in terms of then changing again the trajectory of trend. So what's going to happen here is that they are accumulating for a long time, but if we post this reading are going to look to buy all the time, we're going to get our clocks cleaned here, because we're not noticing, hey, the commercials are actually predicting a multi-year bear market. Okay, so this is what it is. So if we're anticipating the end of the bend, then what we're doing here is we're buying into the beginning of what could be a multi-year bear market. So we only want to do that once, right? We only want to do that once, or as long as the trend is still in play. As soon as now the technical trend is also changing to a downtrend, then we're no longer going to go with the commercials as they're accumulating, right? So if we're buying into the beginning of what could be a multi-year bear market, so I have to put some. On the index, it may look like on the index, it may look like the commercials change their minds, right? But they are not changing their minds. It's just the hedging function that comes into play. So what we're going to write down is commercials may flip-flop rather quickly after an extreme reading, yellow line. However, that doesn't mean that they've changed their minds, right? It just means they're now going, well, into accumulation phase again. That's the hedging function that comes into play. And that's just what they do. As price declines with a downtrend, they just continue to accumulate until they're again at a multi-year high. is when we can then look to buy again. So we're basically anticipating, following the existing trend. We're looking at multi-month extremes, so at 6 months extremes, and anticipating the end of the band, we're looking at multi-year extremes, so at 3-year extremes. Okay, so far so good. So this one works out for a little bit, but then if we don't, if we don't catch the trend changing signs here, then eventually we're gonna jump in front of a moving train and we're gonna get our clocks cleaned as they are accumulating, right? They continue to accumulate into falling prices. That's just what they do. And then only we can speak about two extremes here. We are now down here. It's the first time we go below the red line. And at this point, if I'm going to look at my lower highs, then at this point, I'm going to have a high, I'm going to have a lower high, the same lower high, and I have lower lows and again lower highs. So what we want to do is we now want to sell with the direction, right? We now want to sell with the direction. I don't care if the commercials go up here. I really don't care. What I do care more is when the commercials are now at an extreme, right? So they are at an extreme right here, and they are at an extreme right here in terms of 6 months. Now, what we can state is that now when we're downtrending, so now we have a downtrending condition, and now the commercials are below a 26 weeks extreme, so below the red line, then we want to be selling. Where do we want to be selling? We want to be selling in weekly and daily supply. What's our profitability and what's our accuracy? Well, it has to be rather high as we're following the trend and we're following the commercials with the trend. So what we can see here is that once, okay, then not a whole lot is happening here, or price is also not in supply, and then another time as price goes into a level of supply here and here, then as we get the extreme with the trend, what is happening is that eventually with a slight delay, we see the offset here, and then we see price going into a new lower low as well. So we could say, well, once it worked, once it didn't work. And that's also very interesting to say, because then if we actually look at what the net positions versus the index is saying, well, the net positions would actually say, well, it's just, they're still accumulating up here, right? They haven't moved anywhere. So if we were to look at the nets here, then we would say, well, they haven't moved anywhere. They're still accumulating. So how is this an extreme? Probably not as much of an extreme as compared to here. This is where it is an extreme, because they're just as low as they were here. So, okay, this is much more of an extreme. That makes a lot more sense looking at the nets than this. But if we are just basing now if we're just going to say, well, we're going to look at our index blindly without the nets, then what we're going to have to say is, well, it worked once, and once it didn't work, even though we're not even looking at supply yet, right? So here we got a move eventually. Here we did not get a move. We first got a rally. And can we explain that, or can we not explain it? Yeah, we kind of can explain it. As we look at the nets, we see that this is not a real extreme. But as I look at the prior 6 months, yes, it is an extreme, right? But the real extreme that matters is probably this one and not these ones, right? Because if I'm comparing this to this or this, then this one really didn't matter that much, right? This one really didn't matter that much. And so this one also probably didn't matter that much. And then this one again matters because here we're as low as we're here. And we're going to have to start and color code them as well, right? So to then eventually get some numbers behind our profitability and our probability of success as well, as we're then just going to count all the trades that set up. And then with the trend condition and the commercials, we can count all the trades that set up. And then we're going to divide the trades that set up by the total amount of trades. And then we see how many of them would have worked and how many of them would have not worked. And then you can see your accuracy, basically your probability of success if you were to apply this further into the future. So now an interesting thing is coming up. Now the commercials are above the green line, but we're in a downtrend. What are we going to do? Well, we're certainly not going to buy against the downtrend here, right? So again, what we can write down is if we're downtrending and now the commercials are at a 26 weeks extreme in terms of above the green line, then there's no action, right? There's no action. We're not going to do anything here. We're not going to buy, we're not going to sell. So no trade. Now again, they continue to accumulate until eventually, oh, here we go. They're at an extreme here. They're at an extreme. So what can we do? Well, we can look to buy, right? We can look to buy. And where would we look to buy? Well, we would potentially then look to buy somewhere in a level of demand. And then we may have bought this for a little bit, right? So here is a 3-year extreme for the very first time. Again, this is shifting the narrative into not, well, from here to here, we're certainly bearish. Now we can start looking to be bullish again. So this is where we are bullish for the first time. And regardless of trend, so now we're still downtrending, but now we are at the 156 weeks extreme. We're at the higher yellow line. And now what we're doing is we're buying. And where are we buying? We're buying in monthly and weekly demand. And what is our profitability? Well, our profitability may be very high. However, our accuracy is only going to be medium here in this case. If we were to put something here, we would put low and low here, right? So obviously we don't, that's why we only look to take trades where we have a high level of accuracy and a high level of profitability. I'm not saying there's only going to be always only trades that are high and very high or medium, but what we're doing is we're leaving out the lows, right? There's also low combinations here, but we're leaving them out, right? I'm not even putting the low here. So next, we would say, well, we could buy. Now we could buy. There's 1, 2, 3, 4, 5, 6, 7, 8 weeks. And then again, the commercials are at the red, below the red line. And now we have that interesting combination, just as we had here and here. We had the same thing as we had here and here. So we have the first 6 months extreme after the higher time frame extreme, but we're still within the overall downtrend. So we're still downtrending. Now I'm below at 26 weeks. So I'm below the red line. But this happens post the 3-year extreme. So since I'm still downtrending, I can still sell, right? And I can still sell within the weekly and the daily. However, as I'm doing this, my profitability may be lower and my accuracy is also only medium, right? Because here I'm selling into the beginning. I'm selling into the beginning of what could be a multi-year bull market. So here I can still look to sell, and I may get away with some trades to the downside here. However, what's going to happen is very soon again, the commercials get up here again. Okay, so if they get up here again, that's kind of a cue for us, right? That's kind of a cue for us. And that cue is, hey, let's look into your net positions, right? Let's see what's going on here. So what we're going to see what's going on here is that if I'm going to look at that rating that I'm getting here again, yet again, and I'm going to look to the left, then what I'm seeing is, well, holy smokes, that is a historic level of commercial accumulation. That is historic. What does it mean it's historic? Well, the commercials have never been accumulating so many millions of dollars of real product of wheat before. So they must be perceiving this as extremely cheap. So what should we do? Well, we better be buying, right? And of course, our 3-year yellow line is going to pick that up here. But usually what's going to happen is if we get those 3-year extremes, is what we should do is we should look into the nets and then say, hey, is this historic or is this just an extreme? Is this just a 3-year extreme like this one, right? Because if I'm looking at this one and I'm looking to the left, then hey, we've been here before, and yes, it's extreme, but it's not historic. And or this one, if I'm looking at this, yeah, that's pretty extreme, right? It's even lower than here, but it's not historic. The commercials have been lower before. So there's a difference between, again, a 3-year extreme and a historic extreme. In this case, we go into a historic extreme, okay? And so we have to put this into wording as well. So now we're still downtrending, and now it's a historic based on net positions. And what are we going to do? Well, historic let's just put historic levels of accumulation. We know that it's based on the net positions. Historic levels of accumulation. What are we going to do? Well, we're going to buy, right? Where are we going to buy? Well, here we can only buy in weekly and monthly. What's our profitability? Well, it's the highest. What's our accuracy? It's the highest. Okay. This stuff doesn't happen, right? It doesn't, well, it does happen, but it doesn't happen that frequently. So if it does happen, we really need to be paying attention. Okay. So what is very interesting to see here is that the highest and the highest comes when we buy against the trend. That is a bit odd, right? That is a bit counterintuitive to what we were always taught is, hey, we need to buy with the trend. And yes, of course, we can buy with the trend, and that's all good. There's quality setups that we can find, but the best setups historically are found when we buy with a historic level of accumulation or distribution with the retailers, with the commercials. So if I'm now going back and you can see, they can accumulate here at this all-time high here for quite some time, right? And so they're up here for quite some time. In fact, they're up here from February all the way to June and July. So for 3 months, they're up here. So we could have been looking to buy for 3 months, right? And then we may have, we still don't quite get it. We still don't quite get it. And so when we look at monthly demand, that's going to help us a lot. So these setups, they may take a lot longer to play out, but when they play out, right? When they play out, they're usually massive. And so that is again the start of a right here. That is the start of a multi-year bull market, right? That's the start of a multi-year bull market yet again. Okay. And so eventually the commercials are what again? Flip-flopping. And it may seem like, hey, they've changed their minds, right? And here they even flip-flop into the other extreme, into the yellow area, right? Here they flip-flop into the yellow area. So here it would be like, whoa, they're really flip-flopping. And that's just what they do, right? As price now rallies, that's a hedging function that comes into play. Imagine the more they have accumulated over the past, the quicker they're going to be in flip-flopping, right? Because that's just all of them buying. It's like there's no commercial left that's selling still. So when they've got so many positions on, and likely they have more positions on than they can handle in terms of real product, as they're using leverage, right? So they're prepping for the future. You can see they're pretty fine with, a couple of percentage points rallies. They're ready to distribute, because they're like, whoa, we just made so much money in the real world, and our production cost is so much, we can now produce for so much less, right? Because we bought for so much less. So our production cost over the years is going to be so much less. So, hey, we're happy days. We don't need more, right? I don't need this to double or even triple. They're not speculators, right? They want to make money in the real world. And as soon as they make money in the real world, they're like, hey, that's fine. Now we're good. Now we can distribute and sell some of our produce in the real world. So now they're at that extreme. And yes, we do get a little bit of a decline, but should we say that we would predict the end of the band here? Well, we can see we do get a little bit of a decline, but not too much. Then the commercials are almost up here again. And up here, it's like they're not yet even at an extreme. So we may have not even bought anything here. And then they're down here again. And so again, they're down here for a second time. We're like, hey, what's going on here? Right? What is happening? They're here for a second time. So the first time they're down there, I'm a bit cautious, because that's just what they do, right? They distribute and they flip-flop rather quickly. But then the second time they're there, I'm going to look at the nets. And then when you look at the nets, you're like, oh, whoa, what is this? This is a 3-year extreme, yes. And this is close to being historic, right? Close to being historic. So the commercials have only been here once, 2 times, 3 times. And all of those times when they were close to that reading, we saw a big decline of price. We saw a big decline of price. So it's not historic, but it's close to being historic. it's more than a 3-year extreme, right? If I'm arguing a 3-year extreme, then I'm looking back 3 years. 2008 is here. Well, I'm lower than 3 years ago. I'm lower than 4 years ago. I'm lower than 5 years ago. I'm as low as the commercials were in 2004 only compared to 2011. So it's a 7-year extreme. It's not historic, but it's bigger than a 3-year extreme. It's a 7-year extreme. So the higher the extreme, the better, right? And so close to a historic extreme here. And of course, what should we be doing? Well, we should be selling, right? We should be selling. And so, yes, here again, it's working. We've got our set of rules. We're allowed to sell here. And we may be selling this for a while. Here they start to accumulate again. Do we care? Do we care here? No, we don't. We don't care, right? This is not as per our rules. It's following a change of trend, and then price is also downtrending at that stage as well, where I have lower highs in the process and I have lower lows in the process. So at this stage, even though this would have worked, right? Even though this would have worked, we don't want to buy here, right? We just don't. And then some time passes, nothing is happening until, whoa, wait a second, what's going on here, right? What's going on here? And this is again a 3-year extreme, but it's also a historic extreme. So again, here at this level, the commercials have never been here. It's higher than this extreme, right? We know this extreme led to a big rally, and now this is even higher than this. And so this leads to a big rally here as well, and that lasted for almost a full year, right? It's lasted for almost a full year. So this is creating trends. So then what are we going to do? Well, we can buy whenever we can buy here. And then this is maybe the last time that we can buy, even though there's not yet an uptrend that's formed. We know that the commercials come from this extreme. They're here again. We would still buy this here, right? And so this would still work. And then eventually we're up here. And then again, the commercials are even lower than they were here. So of course, our indicator again is flashing red. And that's now, okay, change of trend. And is this now a historic level? Well, let's see. Well, it's as low as here, and it's lower than here. So this is as historic as it gets for the commercials in terms of distributing. And if we did the exact numbers here, well, if I did the snap mode, and if I did manage to snap this into here, second. Doesn't allow me. But if I did snap this into here, then we would see that this is just as low, if not slightly lower, right? It's just as low, if not slightly lower. So we can call this a historic extreme right here, right? This is just maybe piercing that, but it is slightly lower technically speaking. So this is a historic level of distribution. So what do we do? Well, for sure we don't buy anymore, right? Yes, we're uptrending. We have a higher low, and then we have a higher low, and we have a higher high, and we have a higher high. So we have an uptrend. However, we are at a historic extreme. So we're uptrending. However, there's historic levels of distribution. So what are we going to do? Well, we can only sell, and we can only sell in monthly and weekly supply. And our profitability is the highest, and our accuracy is the highest, right? So almost all historic extremes that you will ever spot within the price charts eventually lead to multi-year bull or bear markets. Okay, so generally speaking, the higher the extremes, the relative extremes in terms of the time period you're looking at, the stronger the potential setup. And so if you are looking at a 3-year extreme, it's better than a 6-month extreme. But a 5-year extreme is better than a 3-year extreme. And a historic extreme is better than all the other prior extremes. The interesting thing is that we can only get multi-year extremes and historic extremes if we're applying an anticipatory trend analysis. We're not trading with the trend, right? Here we're trading against the trend. So it's one of the most difficult, it's thought to be one of the most difficult applications of trading. However, if we have a few rules that allow us to do this accurately, then this is actually, and we're patiently waiting for those setups, then yes, it is still difficult, it's still complex, but all of a sudden we have so much more odds in our favor. And now this is turning out to be a multi-year bear market, big time, right? Big time multi-year bear market. So now what are we going to do for all this time? Well, for all this time, are we going to buy? And here again, you can see that, well, from historic, they're gonna, it seems like they flip-flopped, and then it's like, hey, they changed their mind, but be careful, they haven't changed their mind. It's just what they do. They're gonna distribute into, they're gonna accumulate into declining prices. And so we wanna now, as we see the downtrend, lower high and a lower high, what we now wanna do is we want to sell with the downtrend, right? So we want to sell here, even though here we don't have a fully formed trend yet. Then we want to, again, sell here. And 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 here's where it then becomes interesting again, right? As I'm skipping these ones would be saying, well, and here as well, we would have said, whoa, we're downtrending for a very long time. And what is happening is now the commercials are again at a historic level of accumulation, right? Here and here. That's historic for sure. Right, that's historic for sure. So here and here, well, our indicator would have said here and here, that's historic. And so we're like, hey, whoa, let's look to buy this. And so we may have bought this back in the day, right? We would have bought this. And then it's, well, we got a little bit of a rally, maybe, not looking at demand here even, right? But we may have gotten a 1, 2, 3, well, a couple of weeks, few months of a rally that didn't really have a big magnitude, but it did have it. We did get somewhat of a rally. And then after this, we get another level of distribution, and then we know this is still within the trend. So it's the first one up post longer term extreme, so that's also still solid, right? The first one post a longer term extreme, it's also still solid. And then we're up here again, up here, and then we can, well, we may be looking to buy again, we may be looking to buy, and here it gets very messy. Here it doesn't work at all, right? Or we are still in a downtrend, but now we look to sell, and we may sell well, it may work a little bit, but not too much. So here during this time, we can say that it gets extremely messy, right? It gets extremely messy. And then eventually the commercials go into another historic extreme. And then as they go into another historic extreme, so historic and historic, now all of a sudden, that's the start of a bull run that is not going to stop until very recently, right? That's the start. That historic extreme is the start of all of this bull run that was lasting for a very, very long time. But there was a time here where we would have said, well, this is extremely messy, right? Well, we can go with the trend. That still worked kind of, but it started working less and less and less. And buying didn't quite work with the historic extreme here. It worked a little bit, but not so much. So yes, there are times where it works like a treat, and then there's times that it could still work, but the profitability is not as great. Maybe there's just smaller moves, and then it's going to take a long time for us to actually see something happening here. And that is also normal, right? That is also normal. And there's going to be, as we look at the accuracy, there's going to have to be some losers here. Otherwise it would be 100% accuracy. I cannot come up with a strategy that has 100% accurate, just not yet, unfortunately, right? Still, that's the goal. We are striving towards a high accuracy, but there cannot be 100% accuracy. So there's going to be times where, after all of these years where this just worked textbook, it's the food of life, bread, it's what the world runs on, and it's been traded for hundreds of years, and you can see there's so many lessons that this really teaches us. And then, well, this historic one really gave us a big bang, right? So this was really a big bang. And then what happens is, well, now we only want to buy, right? Now we own, and we come from a historic extreme, meaning that I expect the commercials to flip-flop, right? I expect the commercials to flip-flop. Here they flip-flopped crazy, and that flip-flopping also was very textbook in terms of, well, it flip-flopped, and then we also got a nice sell here. But then who eventually won the battle? Now we're going with the buyers. We are getting higher low. We're getting higher lows, low, higher low, higher low. And now we're just going to buy the higher lows, right? So we're buying here, then we're buying here. Here it did not work. We were too early. Again, this is preceding an extreme reading. So if it's preceding an extreme reading, we always have to be a little bit more cautious, right? So if this is happening post an extreme, we have to be slightly more cautious, right? And here we could even have argued, well, here we have to be really cautious. And here we even have to look to sell, because that again is a historic, at that point, it's a historic reading of the commercials, right? And so that historic reading of the commercials led to a 2018 all the way to 2019. So for a full year, prices just went down, and it also went into a downtrend, right? So historic reading, prices went down, and then eventually prices picked up again. And so we could now continue to put in those lines. So here it didn't work, right? Because it was also, well, it worked for a little bit here, bounce with the trend, but post extreme, with the trend, but post extreme, then we would look to sell with the extreme, and that we get a nice sell. And then eventually what we see is, as we look at the trend shifting to the upside, eventually what we see is that our sells are working very nicely, sell, sell, but our buys are also working very nicely. So we're buying here. We're buying here, we're buying here, here, and here. And as long as we get those higher lows, we can look to buy, right? We're buying, we're buying, we're buying, we are buying, boom. And we're not selling, right? We're not selling here. There's no way we're ever going to sell here, unfortunately. And then all of a sudden we get into an extreme reading here as well, right? So again, what's happening is here we have not seen that the commercials have anticipated anything, but we see the commercials are accumulating, and as the commercials are accumulating, prices are falling. However, we're at a 3-year extreme, and we continue to be going higher and higher and higher, and that is very bullish as well, right? However, it's nowhere close to historic levels, but we are coming from a 3-year extreme, so we could look to buy here as well. So now if we wanted to get the accuracy of all of our different sets of strategies, then what we have to do is we have to count all of the trend following ones. We have to count how many times it's working, how many times it's not working on the trend following. And then we have to count the 3-year extremes. And then on the 3-year extremes, we have to count how many times it's working, how many times it's not working. And then on the historic extremes, they can be part of the 3-year extremes, or we could see them separately. Here, we also have to count how many times it's working, how many times it's not working. And what you would get, as you saw, is we can put some numbers here, right? And we can become, and we could do the work here. And I may do this offline. I'm not going to bore you with that. And you can certainly do that yourself to say, for example, on my uptrending trade, on my uptrends, right? Whenever I saw an uptrend and I got a high reading, let's say you got this in total 15 times. Out of those 15 times, 10 times it worked. So now your accuracy is at 67%. Well, if it worked 12 out of 15 times, then you have an 80%. Well, I'm at profitability here. I meant to go to accuracy here. I have an 80% accuracy. Okay. And then you're going to count all the ones that had an extreme, and you're going to count the winners versus the losers, just very objectively, right? How many times? And of course, we always have to cater for a certain delay in terms of the offset of a future rally and offset of a future decline. And that's why we don't trade it there and then, right? We don't just jump into the markets. We also look to time these with our income strategies and our income vehicles. So we could do this, and then, as we have seen, we could simply just come to the conclusion that, well, if we do an uptrend with the green line and the commercials above the green line, I have a lot of positive trades. I get to predict a lot of rallies. What about I trade with the trend? What about I trade with the bearish commercials against the trend. Well, that's not a good idea. Most of the time we get our clocks cleaned, right? We're wrong more times than we're right. And so that's not a good strategy to follow. No action. That's a very solid strategy to follow. What about uptrending and we're at an extreme? Well, we saw over time it worked over and over again. And so that's a pretty solid strategy. It may have worked less than trading with the trend. However, when it worked, we got a lot of bang for our bucks. And then we could say, well, what about uptrending? And I'm still within the trend, but I'm post an extreme. Ooh, I still have a good accuracy, but both my accuracy and my profitability goes down. We saw this only later as we continued the back test. We only saw this later down the road. All right, only here when we moved from one extreme to the other extreme, and we were kind of bouncing forth and back, and there was this awkward phase here of one extreme into the other extreme and so on and so forth, where we may have not quite known what to do, and we may have been wrong a couple of times here and there. So only here we may have a few losers that come into play. However, if we focus on the big nets, right? If we focus on the big picture, then we are predicting the bell curves, right? And as the bell curves are being formed, as our bell curves are being formed slowly but surely, and that's the entire goal of this indicator, is it's supposed to do both. It's supposed to tell you, well, where is potentially the end of the bend, right? Here we were too early. And then if you're looking at the nets, then they've been up here for a very long time. So that's the end of the bend. And as the trend is down, you can see that also their levels of distribution, right? Their levels of distribution, they work very well. And then as the trend changes into an uptrend, then what is an extreme? And that's very important. What is an extreme here is not, it wasn't extreme here, but here it was a sell signal. Here it's a buy signal. So a big lesson here is that the commercials, what they do, it's always relative to what's happening right now in this market. So what it's relative to the trend condition, and it's relative to where have they come from. Okay, so what we usually see is that with rallying prices, the commercials will distribute. And so what is a high level of accumulation? They will always go lower and lower and lower until they then change, they go up, and as they go up, price goes down, right? And so vice versa as well. If the trend is down, then their level of distribution, this was an extreme, it's always becoming less, right? It's always becoming less. And that is all of a sudden an extreme. Even though, how is that an extreme if that was an extreme? Well, the trend condition is still down, right? So their extremes are going to be less and less extreme until then they at some point have accumulated so much over a long period of time. And this can happen very quickly, like it did here, right? This can be a very quick process until we get a big rally. And then this can be a very quick process until we get a big rally. or this can take a lot of time until something happens. Usually, that's something that I've observed, is it depends on the context of where we're coming from. So if we had been in a 5 or 6 or 7 year downtrend, that downtrend is gonna take a lot of strength, a lot of buying power, a lot of accumulation, a lot of orders for that downtrend, for that 5 or 6 or 7 year downtrend to eventually shift into an uptrend, right? So it's not going to happen from one day to another. While if we're more in a context kind of maybe a sideways or not a longer term downtrend, but maybe less time spent in a downtrend, then it can be a lot quicker that these extremes then start to matter. And so what we can all do in our downtime, and maybe you can do that, is you can count. For example, here, if we were just counting that downtrend and we were saying, well, how many of those were working? Well, once it worked, twice, 3 times, 4 times, 5 times, 6 times, it worked a little bit. So 6 times here it worked a little bit. This is post an extreme here and here, regardless. With that trend, 1, 2, 3, 4, 5, and then this we can say it didn't work. So we had this 6 times and 5 times it worked, and then 6 times, 5 times it worked, 1 time it did not work, right? What about the trend following here on this side? Well, we had once it worked, twice, 3 times it worked. And then here it even worked for the first time, even though we predict the end. So here we're adding 4 or we're adding 3 to our prior 6. So it's now 1 out of 9 that didn't work, right? So then you're looking at, and then you're going to add, well, you're going to add this. What about this uptrend here? Well, when do I see I'm in an uptrend? Kind of here, I see I'm in an uptrend. 1 higher low, 1 higher low. And then it worked. 1, 2, 3, 4. And then 5. And then here we're still within an uptrend. It worked a little bit, but we can maybe say this here did not work, even though, well, it may have worked for a little bit. But let's just count this as a loser, because we could just say, well, this was too early here, right? Let's just say this was too early to benefit. Let's play the devil's advocate here. Now we've got 2 losers, but we're adding 1 loser. And so we've got 2 losers in total, and we're adding 1, 2, 3, 4, 5. 2, 3, 4, 5 trades. So we're adding 5 trades to our prior, was it 9 trades? So we have 14 trades. Out of 14 trades, trend following, we have 2 losers, and those 2 losers are like not the worst losers in the world, right? A loser in terms of, well, the move wasn't that big. And so 12 out of 14. And I'm sure I didn't count all, but if I even added more, then the ratio would probably stay the same. So in terms of if we now have a, if we now are basically slicing those up into just trend following, and we're going to do the math on that. Can I add more of those? Anyways, if I'm just gonna now make a summary here, right? And I'm gonna say, I don't like the design of this all, but I'm gonna say, well, what about the trend following? And what about the end of the band? then my trend following, as we just said, had 12 out of 14 winners. So, hey, my accuracy, if I become really good at timing the markets in terms of the location and adding maybe seasonality to that as well, I'm not going to win all the time. But if I follow this strictly, religiously, then applying this to the future on wheat, okay? On wheat means that I've got an 86% success rate. The end of the band, including historic, I could then count, well, these are now the colorful big lines, and there were some more. This one, there was some more here that worked, and there were some here that did not work. So that's one that did not work, not yet anyways, and then one that did work here, and then one that worked, so two. Here, one that did not work. Okay, so one didn't work. Well, it worked for a little bit. So one didn't work, two didn't work. And then here we said two worked. So it's 2 out of 2 at the moment. Then I have this here worked, this here worked. So 4 worked, then 5 worked, 6 worked, 7 worked, 8 worked, and so 8 worked. What did we say? 2 didn't work, or was it 3 that didn't work? I'm not sure. So 10 trades in total, and 2 didn't work. And maybe I'm now right. This is now just I'm not counting very scientifically, but just to get a ballpark figure and to tell you how this could be done. This now has an 80% accuracy. So, hey, that also makes kind of sense, right? What did we say about the 156 weeks? We said that, well, the accuracy is going to be lower than following the trend. But of course, since it's a bigger extreme, the moves that we're getting out on average should also be bigger. Okay, so the profitability, the magnitude of the move is bigger on the 156 versus the 26. However, my accuracy goes down. So it has to be the case, right? Because it's just more difficult to find the end of the band than to follow the trend. Okay. But it's still medium, 80%. It's still pretty solid. Still pretty solid. And of course, if I'm going to go into a historic one, because I also have a lower sample size, I may get a scenario where it's slightly misleading in terms of the numbers that you get, just because the sample size is not high enough. So what I like to do is the historic ones, I just put into the end of the band versions, so we have 2 versions that were really testing, and even with our post extremes, right? This is something that we have to be aware of when doing the analysis. And these are all the different conditions. You know, there's 1, 2, 3, 4, 5 different commercial versus direction conditions. And depending on that, there's going to be, you have a variable profitability and a variable accuracy. But as we cluster them together into 2 strategies, the trend following one and the end of the band one, which is basically the trend following, the green and the red line, and the end of the band, the yellow lines, and then also double checking with historic extremes here. If we just cluster all of those trades together, then what's going to happen is, on the example of wheat, we are seeing a very high accuracy. Okay. Now, I can cluster together all of my finite markets, and I can give you this blueprint, right? And these rules. And this is now just a skeleton of the overall blueprint that we're going to operate on. So we're going to add the retailers here. We're going to add the seasonality here. And we're going to have to add market timing as well. But then eventually, if you want to trade a market, right? And you can become pretty good at trading already by just kind of clustering together our markets into these categories. But if you want to really become an expert at a market, then you have to do this kind of analysis that we just spent together 1 hour and 40 minutes on. And you have to do this for gold, you have to do this for silver, you have to do this for palladium, you have to do this for wheat, and then when we go into our infinite markets and you want to trade the Nasdaq, we're doing the valuation for Nasdaq, the valuation for the S&P, the valuation for the Dow, and then how about Apple, how about Amazon? And what I hear a lot from people is that the more they're trading a certain market, they're like, well, I always say I don't like Forex. Why don't I like Forex? It's because I don't spend a lot of time in this market. And if I did spend a lot of time in this market though, and I had this table almost instinctively eventually, because I see over time how certain conditions affect price and what to do when, right? That almost becomes second nature if you follow a market for multiple years. Like Toby, for example, who's been following Forex for years nonstop. Of course, for him, it's like, hey, when I talk to him, he's like, Jan, what are you talking about? Forex is so easy to trade. And of course, for him, it's easy because he's got this blueprint set out instinctively. He may have not written it down like that, but he has it in his gut feeling. Well, if we speak about gut feeling, we speak about experience, right? He's got a blueprint for the Forex markets, and not everything that works here for wheat is going to work for Forex the same way. So the more time you spend on a certain market, the better you understand it, and then the better you will trade it as well. And then I, for example, also know traders here also in the room, that love agriculture markets, and they love agriculture markets. Like, okay, how much time do you spend in agriculture markets versus other markets, right? And then it's, well, I spent most of my time in agriculture markets. Well, of course you're gonna have a preference because you spend a lot of time in these markets. And I just like futures markets. I just like stocks, and I like to trade Google, and I like to trade Amazon, and I like to trade Apple, and I like to trade Nasdaq. But that's what I look at every day, every week, every month. And that's what I've been looking at for a decade. So, and that's the blueprint that eventually you can come up with as you follow those markets for a very long time. And then if we want to speak about statistics, we can apply statistics here as well. But as you can see, there's a whole lot of work that has to be done, and objective work, right? And I did my best to play devil's advocate here and put in more losers than winners. And even if I say, well, we have a margin of error in the way how I counted, so I have 2 more losers here, and I have maybe 1 more loser here, right? Or maybe even 2 more losers here, I'm still way above my 50% accuracy that I'm trying to achieve, right? And so I could play devil's advocate on the numbers that we just kind of came up with. But either way, they're really solid numbers for wheat. And it doesn't mean that another market is going to be exactly the same way. And then what you're gonna, well, this is something that we could put here, right? So if we're gonna say, well, I think if we were calculating the accuracy on those trades, and the profitability on those trades where we trade against the trend with only a monthly extreme, then that's going to be very low. And then here we could say, whenever we follow the trend or profitability, we don't have a way to measure that. Now, what would be very interesting, and that's gonna be the next that's going to be the next campus tool, is that's where AI is going to come into play, is the table that I'm looking at all of our tools, and then having a smart software that looks at all of those combination, uptrending, the kind of commercial extreme, the kind of location, the kind of seasonality, and then seeing what the downside is versus the upside, what's the time of the rally, what's the average rally time, what's the average decline time, what's the drawdown, what's the upside in terms of the magnitude of the move in terms of percentage gains or potential percentage losses. And then also a tool that learns on its own, that with time is going to say, well, oh, this didn't work. Why did it not work? What were some of the criteria or parameters that were or were not in place that either a trade worked or didn't work? So with all of the tools that we have, so it's kind of a hybrid artificial intelligence, right? I'll call it hybrid artificial intelligence because the computer tells us what to do. However, we as the human interface are sitting still in front of the screen, and based on the readings and based on our back test that we did and based on the past performance, we're going to predict the future. However, if we develop a very smart machine that thinks exactly the way how we think, that may have a lot of potential, right? A lot of potential. And that's kind of the next level, but that's an investment so large in time and capital that, we push this down the road a bit, but that is the future goal, if you will, if you look at all of the indicators, software and strategies that we've developed so far, is eventually we need a AI that's going to do all of this work that I've just done manually with you for us. And that's then going to say, in terms of profitability, in terms of max drawdown, average drawdown, in terms of max gains and average gains, in terms of how many times did we get a winner after a certain period of time, looking at maybe 6 months or looking at a year, a period of a year, and playing around with that. And ideally the computer knowing then eventually what kind of time period it has to use. What's the average win to loss ratio if you follow just simple things like following the trend and then whatever the commercials are doing. But then it gets so complex, right? I'm saying this is a skeleton. I'm introducing the blueprint here because as we do this on the skeleton, it's not yet that complex. So the back test becomes very easy. We're not yet looking at the retailers and how the retailers may or may not increase our accuracy. Because if the retailers are on the opposite side of the trade, I'm like, hey, well, in reality, if the retailers on the opposite side of the trade, I should have a better accuracy here, right? So we can test that as well. And then we can test, well, during what times is it best to have the commercials bullish, right? And where do I get the biggest moves? And then where do I get a variance in terms of profitability? So this can be, the blueprint can be very complex. But what I have to do in favor of saving time, in favor of making it, well, simplifying the approach, is I have to categorize the assets that we trade, and I have to categorize when we use which kind of tool. However, I also want to show you that when you want to become an expert at a certain market, this is the approach that you're going to follow. You're going to create a blueprint for each and every market using all of the tools that we have, and then applying an objective backtest from left to right, not from right to left. And as we do that, I'm going to show you later on, this is going to be important when we talk about, this is now the last point that I'm mentioning for today. When we talk about when seasonality, it's going to be important to base the seasonality backtest based on our true seasonality tool. And that is where we have a big advantage in the game, because our true seasonality is true because it's recalculated every single day, every single week, every single month, based on the most relevant data points. Okay, so when I'm saying, well, today I have 9 out of, well, this month I have 9 out of 10 winners in all of the months, looking at in all of the, let's say, well, we're looking at April. Okay, so soon as April. So in April, 9 out of 10 years in the past have been bullish for wheat. Just saying this now randomly. Okay, now this may be true, but now applying a 90% accuracy on this is quite misleading, because that would say that you had a time machine back then and you could have seen the seasonality that bakes in past data and spits out a future result. You would have said, well, I have a time machine, and 9 years ago, I would have known that it's already a 9 out of 10. While 9 years ago, looking at the data 10 years prior to that, things may have been very different. And the seasonal pattern that you will see that the true seasonal indicator comes up with is going to be very different. So basing the decisions always on the true seasonality as we backtest and not on the future true seasonality is going to be very important when we do the when backtesting. But I may be getting slightly ahead of myself here as we talk about seasonality. However, as you can see, this can become as complex as we want it to. We spent now 2 hours on this, and in my opinion, this is a skeleton of a blueprint, right? We haven't even talked about market timing. We haven't talked about the retailers. We haven't talked about seasonality. We haven't talked about the lower time frames. And we only talked about wheat, which is a market that can be categorized as a finite market. We haven't talked about infinite markets. We haven't talked about man-made commodities. So we've got lots to do still, and there's going to be many more sessions to come. So at this point, I would end the sessions. You guys can stay online and ask questions. If not, thanks for staying around, watching until the end. Happy and safe trading, and ciao.